Hello friends, this is Dr. Amarjeet Kaur. I am working with Gurugram University in the Department of Management. I am Professor of Accounting and Business Communication. It's my privilege that I am here with you to talk about capital structure. So friends, it has been couple of months that we started with this series on financial management, and in the very initial sessions we talked about three important decisions we make in financial management. One is investment decision, second is financing decision, and third is dividend decision. So with regard to the second decision, which is investing decision, we have to decide where to invest, either to invest in a new plant, new machinery, new project, new product. So that decision belongs to acquiring asset, means belongs to the balance sheet, asset side of the balance sheet, whereas the financing decision is pertaining to the liability side of the balance sheet, where we decide how to fund those assets. So let's say if I have to buy a machine of 1 crore rupees, so who would be funding that machine? Shall I be raising new capital to fund that machine or to buy that machine? Or will I be borrowing some debt from a bank, or I will be borrowing through debentures? What shall I be doing, right, to finance that asset? So investment decision pertain to the asset side of the balance sheet, and financing decision pertains to the liability side of the balance sheet. Means, so because we have equivalent amount of asset and liability at any given point of time, so it means the assets are always supported by some liability. That liability could be towards the outsider, towards the owner, which that is equity capital. So the point I am talking this day is on how to structure the finances or the funds we use in a business. We call it as capital structure. Means if I require 1000 rupees or 1000 crore rupees for a business, how much would be coming from the equity or ownership fund, and how much of this 1000 crore would be coming through the debt funding. So that is what is the agenda for discussion. So to understand what capital structure is, it refers the way a corporation or a business finances its assets through some combination of equity, debt, or hybrid, the mix of the two. So when I am talking about structure, the capital structure, it means I am talking in the total funding, how much would come from equity, how much will come from debt, or even the hybrid form. Hybrid is the preferential capital, or there are so many debt instrument which has certain features of equity, so they are termed as hybrid. So primarily we have total funding sources, either equity or debt, right. Hybrid would be having either some feature of equity or some feature of debt. In equity, when I am saying equity, is not only the equity share capital, I am talking about the preferential capital, which is the ownership, which is not the ownership fund, but has hybrid feature. And then the share premium which we raise, retained earnings which are undistributed profits, they all are part of equity. You may take it only the equity, share premium and retained earning, and you can put, if you want, the preference share capital separately in hybrid head. So most of the times we talk about debt and equity in literature. This is how it has been discussed. So that is the same way I am pursuing this matter here as well. Coming to the debt side, it is not only the debentures, it is the term loan which a business may raise for a particular term, maybe 10 years, maybe 15 years or long. Debentures we all have discussed initially. They are debentures, means they are debt instruments giving the right to the debenture holder to claim for principal money and the interest whenever it becomes due. Deferred payments are also actually the source of funding. If you have to pay somebody, you don't pay. Let's say if I have to get salary, after working 30 days from my employer, and employer fails to pay for 15 days. So what is that? That is the liquidity they are enjoying for 15 days, because that money belongs to me, because I worked for it, right? So the payment, same way to suppliers. Suppliers have supplied you goods, but you delayed the payment by 1 month, right? You got the credit to pay the pay for the supplies. So that is known as deferred payment liability. Even that is a source of funding. That is also a debt funding or debt capital. And any other long term debts, be it project loan, be it overdraft facility. So we have equity capital and debt capital. So these are the two major source. Everything is divided into either equity format or the debt format. Now question comes in, do we have anything like optimum capital structure? In the context of capital structure, do we have anything optimum capital structure? Can we call any situation as optimum capital structure? So to answer that question, we need to understand what is optimum capital structure. So the optimum capital structure is that capital structure or a combination of debt and equity that leads to the maximization of the value of a firm. Means it is a point, where, or rather a trade-off point, where the value of firm is highest. In all the decisions, the agenda is to make the value of firm higher or maximize the shareholders' wealth, because that is the objective of financial management. So we want to increase the shareholder wealth, we want to increase the value of the firm. So optimum capital structure is a situation where so out of 1000 crore rupees I need, the example I am quoting, how much is coming from debt, how much is coming from equity, right? So what is the best point where the value of the firm will be highest? So that is the concept I will be using or discussing or referring to for many a times in my many future lectures, not only today. Okay, so this is the concept of optimum capital structure. Having said so, the next question comes in, what are the factors which affect the capital structure? Because ultimate objective is to reach to a point, in capital structure means to reach to a point of debt and equity, the combination in such a way that my value is maximum, and to reach to that point there are so many factors which play a role. Few of the factors would be good for one, are more important for one firm, less important for other firm, and vice versa. It means all the factors do not play equivalent importance in deciding the capital structure for all type of firms. So what are those factors? So there are so many factors I am going to discuss. So to name a few, the first factor is control, then business risk, financial risk, return to equity shareholders, tax consideration, cost of capital, trading on equity, investors' attitude, legal provisions, profitability, growth rate, purpose of financing and period of financing. So I will be discussing all these factors one by one in detail now for the remaining session. So first factor, that affects the capital structure decision, right? That how much should be coming from debtor or debentures and how much should be coming from equity depends upon the philosophy, the ideology or the idea the promoters or the owners have about control. So because equity gives right of voting, we all know this, but debt holding doesn't give you any right to vote. There are exceptional circumstances for preference shareholders, but prima facie the equity shareholders have right to vote, and through that voting right they can actually control the business by participating in the board of management meetings, general bodies meeting, and by choosing the directors, right? So, what is the idea of firm or the promoters or owners about control? Are they okay with, because in equity shareholders, in equity funding, if there is a higher amount of equity funding, the control is, there is a likelihood that control of the business or the decisions will get diluted. It may not, it may also, right. Whereas in debt funding, we do not have any such risk of losing control. So, the first factor which management has to take or the promoters have to take is about the control. Are you okay with this idea that your control of business is it gets diluted or is actually in someone's hand? Because in debt funding, the control remains with the promoters. If you are a firm which is 100% debt oriented or using debt funding in the capital structure, your control is absolutely in your hand, unless in project funding or project financing or term finances, where we have certain kind of caveats, negative caveats. But in general, the understanding is that control will have effect on the capital structure decision, or vice versa. Capital structure decisions affect the control as well. The second factor, as I said, is about the risk pertaining to business. So, we call it as business risk. So, what is the effect of business risk in deciding the capital structure? Let us see what is business risk. Business risk is you being not able to sustain business, right? Not being able to generate enough cash flows to sustain your business. If that kind of risk is there, then you may not like to have more debt funding, because you have to serve the debt. If you get money through debentures, through term loan, through overdraft, you have to pay the principal money. Along with that, you have to serve the debt, means you have to pay the interest as well. So, the companies which have or which would have more financial obligation, in the term of debt funding, they would have higher business risk, being not able to generate enough money to pay them. And that is also linked to other factors like economic conditions, or the product you are dealing, or the stage of growth you are in, the industry you are working in. There are so many factors which decide the business risk, and business risk varies from business to business, varies from industry to industry. So, you have to take a call as an owner of the business or promoter of the business or management of the business, that what kind of business risk you are at. If your business risk is higher, means you are not able to generate enough cash flows, then or you means you can't, there is a risk of sustaining the business, then it is not a good idea to go for debt funding. In that case, you should be spreading your operation to the extent of your own investment. The financial risk is being, the risk of not being able to serve the financial obligations, like not being able to serve the debt. Financial obligation, financial risk arises because we get funding through debt, right, and not being able to serve that debt is financial risk. So, how much risk capacity you have, or how, if your business is sustainable, if your cash flows are very sure about, then you are certainly, or you will be able to serve the debt, right. So, financial risk would be lesser for such people. So, this is another factor which will be taken care in designing and deciding the capital structure. Then return to equity shareholders. So, equity shareholders do not have any such fixed percentage of dividend return on the instruments on their shares, like debentures have very much a prefix on the debentures saying 10%, 12%, 11% debentures. Likewise, the preference share capital also on the instrument has a prefix saying 8, 9, 10% dividend. But in case of equity shareholder, there is no such decided or pre-decided rate of dividend but nevertheless equity shareholders, they actually expect higher rate of return. Why? Because they have risk. They are taking higher risk than debenture holders or debt holders or even the preference shareholders. Reason being, there is no promise to them for income, as well as there is no promise to them for payment of their principal investment. It is always a residual right, right? Equity shareholders have residual right on assets at the time of liquidation, and also the residual right on income of any year. It means there is no certainty of income, there is no certainty of payment of the principal at the time of liquidation. So, in that case, this asset, this investment the equity shareholders who are making becomes more risky. More risk means more higher return expected. So, how much return to equity shareholder should be given so that the value of firm is not affected adversely, because at the end of the day everybody is investing for the purpose of some return, right? So, this return expected by shareholders will depend upon market condition, normal general growth prospects in the industry or in the economy, the rate of return on treasury bill, etc., which is kind of confirmed income. So, vis-a-vis the premium these people will expect for investment in your company as shareholders. So, these are the factors which will decide the return expected by equity shareholders. So, this is also a factor which is taken care while designing a capital structure, because in general debt funds are cheaper than the equity shareholder, right, equity funding, and the difference of return on investment ROI, then the payment we make to the debenture holders in the form of interest is known as trading on equity, right. I repeat, trading on equity is a situation where the return on the overall funds which are used in the business is higher, ROI or ROA is higher than the payments which are to be made to debenture holders or debt fund holders in the form of interest. The difference goes to whom? The difference is something which belongs to equity shareholders only, because they have residual right after serving debentures, after serving preference shareholders. So, this is the return to equity shareholders. So, how much return would we like to pay? So, if I want to pay higher returns, I would like to take higher risk in terms of using more debentures, because the trading on equity will give higher benefit to equity shareholders. So, this is another consideration in deciding the capital structure. Then the tax consideration is another point. So, how does tax affect capital structure? So, the interest which is paid to debenture holders or debt funding, be it term loan or overdraft or any kind of bank loan, that interest paid is a tax deductible item. For the purpose of calculation of tax, we deduct the interest, whichever amount we pay, whatever amount we pay, we consider that, right, and thereafter whatever is left is taxable amount. Whereas dividend paid to equity shareholders is the appropriation of profit. It means after we pay tax, whatever is left, out of that we pay dividend to preference shareholders. After paying dividend to preference shareholders, whatever is left is used to pay to the equity shareholders, right. So, tax consideration is important. What kind of tax bracket are you in? Number one, what kind of are you any kind of tax exemption? For example, startups, they have certain policies, certain products, certain SEZ areas, there is a tax tax relaxation for 3 years, 5 years. It all depends how much is the importance of that particular industry or company for the national security, national cause, etc., right. So, tax considerations are again important aspects while designing the capital structure. Then cost of capital. The cost of capital is what? Cost of capital is weighted average cost of capital, right? So, if I say there are only two sources, debt and equity in the capital structure, debt let us say is 5% and the equity is 10%, right? And if I am using 50-50, then the weighted average cost would be different if I use 40 by 6, 40 is to 60 or 60 is to 40, right? So, because it is weighted, so weights multiplied by the cost. So, if I am using 50% debt and 50% equity means 0.50 multiplied by 0.05 plus 0.50, that is 50% of equity multiplied by 0.10, 10% of equity. So, that gives me weighted average cost of capital. So, my cost of capital will go up or down if I increase or decrease the debt funding or equity funding, and percentage of either of the two. The moment I change the percentage of either of the two, either debt or equity, my cost of capital is going to get affected. So, how much cost of capital you can afford as a company? Because there are certain industries where the margins are 20%, 25%, 12%, 18%. There are companies there are industries rather, which are working only at 5-7% of margin. So, your cost of capital in any ways cannot be higher than your the return you get. It has to be less than that, otherwise you can't sustain your business for sure. You can't run it for even 2 years, right? So, you can't pay out of your own pocket. So, you need to earn more than the cost of capital, and cost of capital is the weighted average cost of capital. So, you have to be careful about the cost of capital, and because it affects your capital structure decision. Trading on equity I have already discussed in the context of the risk return to equity shareholders, because that is also that affects the benefit of the trading on equity. How much trading on equity we can have will be based on the combination of debt and equity. The other factors which affect the capital structure, as I showed you earlier, number one is investors' attitude. How is the investors' attitude in the market in general towards equity investment or debt investment? Number one, these two form of investment. Also, how is or what kind of attitude investors have towards the industry you are working in? It's just not towards debt and equity. There was time when in India, if I refer to certain decades ago, there were very few people who were investing in equity. Yes, I say it again. There was hardly, it is just recent years we are seeing growth of retail investor in shares. This was only the institutional investors who were buying shares of companies or shares of institutions. Retail investor was hardly there, right? That was the attitude. Now gradually we have young generation, they are taking risks, they are investing in mutual funds, they are investing in retail shares as well, they are investing in SIPs. The investors' attitude has changed towards equity, towards mutual fund for that matter, right? So, what kind of, so it all depends which country we are working from as a company, which industry we are. Investors' attitude could be different in different industries. Like 10 years ago, the investors' attitude towards IT industry was very positive. Industry was rising like anything, and now we know at this moment, even this week, current week only, how badly the IT industry is falling because of AI and ML. We have seen the very famous, I do not want to name that company, a very famous company is out of the 10 best league companies in the country, right. So, because of these developments in artificial intelligence and machine learning, the investment in IT sector is changing, right. So, attitude is different now towards IT. Now, the attitude of investor is more positive toward AI and ML based companies or GAI, etc. Then the legal provisions. every company cannot actually borrow funds through debt or through project financing. It's especially debentures. Debenture raising is not everybody's cup of tea. You need to have certain approvals. You need to have you need to prove that you have profits of last 3 years. You are running in well. You have to seek credit rate. You need to seek ratings from credit rating agencies, and there could be a possibility that you are already have some debt on you, and there are caveats in those debts which tells you not to raise any further debt. So it becomes legal provision, right? So seeking rating from a credit agency, then provision like caveats, negative caveats, where you are not allowed to raise any further debt funding. So these are legal provisions, so you have to comply with that. So once designing the capital structure means combination of debt and equity, you have to take care of those legal provisions. Another point is profitability. Profit and profitability are two different terms. Profit is the difference of revenue and expenses, whereas profitability of rate of return we get on assets or capital invested. So how is your profitability? Are you earning that much that you will be able to serve the debt? So that also helps you decide the capital structure. Growth rate, if you are growing well, or what is the expected growth rate, both are the factors which will help you decide the capital structure. And the last thing is the purpose of financing and period of financing, both I will be talking. So what is the purpose of financing? Because when we go in the market to seek debt or equity, we have to specify the purpose, that we are setting up a new plant, new project, etc., and how long the period, how long I am looking for the financing. Long term financing are more expensive than short term financing, because short term you know that you will be getting paid earlier, so you will be able to raise at a less price. So period and purpose, they both also help affect the capital structure decision. They cannot be ignored. So friends, these were the factors which affect deciding the combination of debt and equity, which means capital structure. I hope I was able to help you understand that. Now this is the time to sign off. Thank you.